Good evening and welcome to Money Minutes. My name is Lisa Pallavi Barura. Last week, the union budget was tabled and investors and markets had a lot to digest. Mutual fund investors in particular had some proposals on the taxation of schemes which they now need to look forward to. Kaizad Adajania has joined me and he's going to tell us a little bit more in detail about this. Hi Kaizad. In the union budget, there were some proposals around taxation of non-equity schemes. Can you give us some details on what has been proposed?
Okay, so basically two main proposals is that one is that if you hold your investments for more than 3 years only, then your investments in these so-called non-equity mutual fund schemes would qualify for long-term capital gains taxation. Earlier the time period was 1 year. So that's one big change. The other big change is that earlier for long-term capital gains tax, in these non-equity funds like your debt funds, you had a choice of choosing either 10% rate, which was without indexation, or 20% with indexation. Now it's flat 20% for everybody, and of course there's a minor change in the way the dividend distribution tax is computed. So these three are the main changes that have impacted the mutual funds industry.
Okay, so they are going to impact the non-equity schemes. So is that only debt funds or other funds also get included?
Yeah, you're right. So basically there are other funds also. So basically non-equity funds means your debt funds, your liquid funds, your short-term bond funds, your FMPs, your monthly income plans, even your gold funds, your international funds, and so on and so forth. So everything which is not equity fund will get classified in these non-equity schemes, will be covered by this budget proposals.
So how does this change the investor's life? Does the investor need to now worry about higher taxes, and is there anything that can be done?
So basically the most important, the biggest change which has come in this budget is that they have reduced the attractiveness of the very short-term nature of a product of a debt mutual fund scheme. Now basically liquid funds and ultra short-term funds, anyways people used to invest for less than a year, so that's nothing has changed over there. But there used to be this bracket of 1 year to 3 years where a lot of funds like fixed maturity plans and short-term bond funds, they used to target investors who want to park their money for 1 to 3 years. So this basically bracket will be most impacted. Taxes are already obviously they'll go up and the attractiveness will go down, and these instruments now will be on par with your bank fixed deposit as far as your taxation goes. So obviously this segment will be most impacted, and also this will also impact investors who had invested in fixed maturity plans before the last financial year ended, hoping that they would get double indexation benefits. Okay, now double indexation benefits in short means what? That your cost price of a product gets inflated to such an extent that the cost price at the end of the term is more than the selling price, which means that on paper you show a loss. Actually you've made a profit, but on paper you show a loss, and therefore you don't pay any tax. So this is called double indexation benefits. This benefit will definitely go, because now your definition of a long term itself is 3 years. Okay, in double indexation benefits, FMPs were only of tenures of, let's say, a little over 1 year, or 370 days or 400 days or something like that. So that's going to be a major hit, and these kind of FMPs are now going to, mostly they will shut down.
Thanks, Kaizad. So there you have it. The changes proposed in the budget are definitely going to impact your fixed income scheme taxation, at least for this financial year. So you have to give it a rethink. That's all from us. Do keep watching Money Minutes for more investment ideas and updates. Thank you.